three major stocks at 52-week lows. Microsoft, Intel, Disney. Let's go see if they're a buy right now. So first one, Microsoft. Guys, Microsoft was a company that was considered dead. We're going to our Everything Money channel. If you have the software, please follow along. It makes it a lot easier for you to learn their software even further. But it was considered dead 10, 12 years ago. The stock was at low 20s. Now it's at 244. And look at this chart. It hit a high of 350, right around there. And now it's at 244. That's a 30+% drop. So some would say, don't fall for the trap of saying, oh, the stock is down 30%. It's a good deal now. It's a better deal. Doesn't mean it's a good deal. There are very two distinct differences between those two. Let's go to our 8 pillars tab. And look, guys, according to our 8 pillars tab, it's still saying valuation's high. Now, does this mean that you should avoid the stock? No. If you knew Microsoft had 20% growth the next 10 years left, you'd be buying this all day long. Because everything else is a check mark, growing 20% a year. Growth is a very important aspect to any sort of valuation model, right? Unless you're doing a liquidation model. But if you're valuing the company for an ongoing basis, growth is an integral part to see what the company is worth, because every investment is the present value of all future cash flows. And if the revenue is going to grow 20% a year, those future cash flows are going to grow even more than 20% a year because the margin of the company is higher. We look at this and see all the checks except for the valuation metrics. Dividend, 1%, very small, but they can easily afford it. $17.7 billion paid out in dividends versus an average of $45 billion over the last 5 years in free cash flow, and versus $64 billion in last year's free cash flow. A high return on invested capital of 17.7%. So let's go to our stock analyzer tool and determine, based on our assumptions, what Microsoft is worth to us today. So for Microsoft, it's grown a lot. Their 10-year average revenue growth is 11%, 16.1% in the last 5, and 20% last year. So their actual growth is increasing as time goes on. Our goal as value investors is to still be cautious going forward. So I'm going to sit here and put in 4 on my low side, 6 on my middle, 8% growth on my high side. Okay. I think for a company this large, they're very reasonable aspects. I think they could hit 8. I think they'll crush 4. So let's be conservative. And I think 6 is probably where they're going to end up being. Profit margin, 28, 30, and 32. Free cash flow margin, I'm going to go 30, 31, and 32. PE, 14, 16, 18. I usually do 13, 15, 17, but here Microsoft's got quite the hold on people. It's hard to leave Microsoft. So I'm willing to pay a little bit of a premium for them. Keep in mind, 10 years ago, Microsoft was selling at 9 times PE, 10 or 11 years ago. And finally, my desired return, 12.5%. Because guys, you can get 9 or 10% from investing in ETF. So do 12.5% here to give yourself some margin of safety. So guys, as I said, 244 is cheaper, but it's not cheap enough. I have a low price around 100, high price of 165, a middle price of 125. Now, if any of these numbers are attractive to you, hit the plus mark, add it to your watch list at those prices, notify me, it'll let you know. But here's the key. Let's change these assumptions if you think I'm too conservative. Let's go 6, 8, and 10, and let's go PE of 15, 17, and 19, just to show you how overpriced this company is. It's still overpriced based on these numbers. So that's the key when evaluating businesses. That's the reason why the stock analyzer tool is so useful. You can change the assumptions very quickly to see what it pops up. Second company, Intel. So let's go check out Intel here. Let's go back to the main page, 8 pillars, INTC, boom. Now, Intel had a high of $58 and a low of 37, and it's currently sitting at 37.89. So 20 cents ago was as low. Now, Intel is paying a 3.9% dividend that eats up $5.7 billion. If you look at their free cash flow, it is down a lot, but this was expected. They announced they're going to spend a lot of their free cash flow going forward, building out factories, expanding themselves to compete with the AMDs of the world that are clipping at their heels. High return on invested capital of 10%. And let's look at their 8 pillars tab. This is actually no longer an 8-pillar thriller because of the free cash flow. It used to be 8 pillars, all 8 check marks, but the cash flow is down, which doesn't concern me because it's not like they didn't plan for that. They planned for the free cash flow. If you look at their cash flow statement right here, look at their cash flow statement. Look at their jump in capital expenditures. From 12 billion 5 years ago to 20 billion last year. That's a big jump. That is a very big jump. What should you expect to pay for this business as time goes on? So for Intel, here's what we're going to do. we're going to look at Intel's earnings per share estimates from analysts. If you look right here, they're expecting a 19.5% drop this year, 25% drop from there, and then increasing from there. We're looking at a 50% increase in their earnings per share over the next 5 or 6 years based on analysts. Now remember, guys, analysts should be taken with a grain of salt, but it's some sort of guide to sit there and see because they do get intimately involved with these companies, talking to executives, etc. Okay, now let's go to their revenue growth. The revenue growth is expected a very paltry 0.5% here, but increasing big time. I'm gonna tell you guys right now, if they hit these numbers right here, this is gonna become a growth stock again. So your job as a value investor is, if you believe these, to buy these shares as cheap as possible. So are they worth it today based on conservative estimates of growth? Let's go back to our stock analyzer tool. So here we are. I'm gonna make 2, 4, and 6% revenue growth estimates. Profit margin, I'm gonna go 21, 23, and 25%. Free cash flow margin, now remember, free cash flow is gonna be a lot lower. So I'm gonna keep it around the 18, 19, and 20%. PE, I'm gonna go 13, 15, and 17, 13, 15, and 17, and I'm gonna do a 12.5% return. Analyze button. The stock is currently at $38. It's basically all check marks because all green, because this price is $37.28, which is the current price is $37.96. So if you believe any of these assumptions here, you're probably gonna do okay buying the stock right now. As long as they can implement that plan they're talking about and the analysts are right, you're going to do very well in the stock. Stock number 3, Disney. Now, guys, this is a big one. So Disney has fallen hard, but then rebounded. Let's look at their revenue real quick before we go into anything else. Look at their revenue. 44, 47, 50, 55, 55, 57, 60, 78, 58, 77. When they shut down their parks, but then they rebounded very quickly thereafter. Disney Plus is generating a lot of revenue for them. They have over 100 million users, each one paying, how much is Disney Plus? $6 a month, $5 a month? That's $500 million a month in extra revenue for them, okay? And they own a lot of titles. So it's gonna be hard for the Netflix of the world, the Amazon Primes to get their titles if they choose not to release them. Let's go back to the main page here. So look at Disney's 52-week high, 187, 52-week low of 93. They are currently at 93, their 52-week low. All right. Let's go to the 8 pillars tab. Now look at this, guys. All X's. Everything looks terrible. Why? Their free cash flow is down 9 billion a year. So their debt's super high. They issued shares to stay open. Everything's just bad here. Everything's bad. So some of you might look at this and say, well, it's the 8 pillars. We got to get rid of that. No. Pump the brakes. This is Disney. This is one of the brands of all brands, guys. This is the moat of all moats, in my opinion. Like, nobody's replacing Disney anytime soon. The market cap's $170 billion. If I gave you a check for $170 billion today, you would not be able to replicate Disney. I'm sorry. Whatever you say, you cannot do it, even with this check. Okay? So, let's go. Let's look at the stock analyzer tool. The great news about stock analyzer tool is it's going to sit there and determine the value based on the future. The past was crappy. So let's focus on the future. Let's do revenue growth. I'm going to go low, 2, 4, and 6. Profit margin. I'm actually going to go on the higher end of the profit margin. I'm going to go 8, 10, and 12. Free cash flow margin. I'm going to do the exact same thing. PE. I'm going to do 15, 18, 15, 17, and 19. 15, 17, and 19. Guys, this is a moat of all moats. I'd buy this thing all day to 15 times earnings and free cash flow. And 12.5% return. It's still saying it's overpriced, but it's close on the high side. Guys, I know this sounds shocking, but every investment's the present value of all future cash flow. You can alter these PEs to make it better than you think before. So let's do this, 17, 19, and 21. It barely makes the top one a buy. Now, if you believe all the top assumptions here, right here, you're gonna buy the stock. So you're gonna start buying the stock right now. The question is, are you gonna be the investor? And I would understand that with Disney. But for me still, I'm going to be patient because I want to buy great companies at good prices. I do believe it's possible to buy great companies at great prices if you're patient enough. But the question you have to ask yourself is, where do you stand? And it's okay if you say, you know what? I really like all these assumptions. Go do more research. Make sure you're not missing anything on Disney. I mean, it's Disney. Then go do that. Guys, if you want to learn more about our value investing strategies for 2022, please click the link above to watch that video.